Imagine a vast cosmic dance floor where inflation and unemployment waltz in a delicate embrace. As inflation rises, unemployment tends to fall, and vice versa. This intriguing relationship, known as the Phillips Curve, has captivated economists for decades. The Phillips Curve is not just an abstract concept, it has real-world implications for governments, businesses, and individuals alike. Understanding this curve is crucial for making informed decisions about economic policy and navigating the complexities of the economic landscape. Just as the stars influence the tides, the Phillips curve helps us understand the ebb and flow of inflation and unemployment. By studying this relationship, we can gain insights into the forces that shape our economic reality. In 1958, economist AW Phillips observed a curious pattern in the data. He found that years with low unemployment rates in the United Kingdom tended to coincide with years of high inflation. Conversely, years with high unemployment rates often experienced lower inflation. This observation was later confirmed by other economists, solidifying the concept of the Phillips curve. The curve suggested a trade-off between inflation and unemployment. Governments could, in theory, choose a point on the curve that represented their desired balance between these two economic indicators. The Phillips curve can be explained using the model of aggregate demand and aggregate supply. When aggregate demand is high, businesses increase production and hire more workers, leading to lower unemployment but potentially higher prices. When aggregate demand is low, businesses cut back on production and lay off workers, leading to higher unemployment but potentially lower prices. However, this trade-off is not always straightforward. The Phillips curve can shift over time due to various factors, including expectations and supply shocks. For instance, if people expect high inflation, they may demand higher wages, leading to a wage-price spiral that shifts the Phillips curve upward. Similarly, supply shocks, such as a sudden increase in oil prices, can also shift the curve. These shocks disrupt the balance between inflation and unemployment, making it more challenging for policymakers to steer the economy toward a desirable outcome. Understanding these shifts is crucial for interpreting the relationship between inflation and unemployment accurately. It highlights the dynamic nature of the economy and the need for flexible policy responses to changing conditions. Economists also distinguish between the short-run and long-run Phillips curves. In the short run, there may be a trade-off between inflation and unemployment, as described by the original Phillips curve. However, in the long run, this trade-off disappears. The long-run Phillips curve is vertical at the natural rate of unemployment, which is the rate of unemployment that exists when the economy is operating at its potential output. This rate is determined by structural factors in the economy, such as labor market regulations and technological progress, and is not affected by monetary policy in the long run. Attempts to push unemployment below the natural rate through expansionary policies may lead to accelerating inflation without any long-term reduction in unemployment. The experiences of the U.S. economy in the late 1960s and early 1970s, as well as the 2008 to 2009 financial crisis, illustrate the complexities of managing inflation and unemployment in both the short and long run.